In most real estate transactions, a buyer won't be able to purchase a property entirely with cash. Generally, buyers have to rely on some form of financing, and there are many different forms of financing available. The trick is to find the type that best suits the individual. For the most part, sources of mortgage funds can be separated into private lenders and government financing. Private lenders include a few different options. The most common would be savings and loan associations, credit unions, and commercial banks. These lenders generally offer conventional loans and some form of government-insured loans. These might include FHA, VA, and USDA loans. FHA loans are for first-time homebuyers. VA loans are directed toward veterans, and USDA loans are intended to serve those living in rural areas. The benefit lenders see from financing a government-backed loan is that the government is essentially co-signing with the buyer and will be responsible for repaying the lender should the borrower default on the loan. For some buyers, there also may be the option of using owner financing. This is when a seller agrees to privately finance the purchase and the buyer makes their monthly mortgage payments directly to the seller. Owner financing isn't as closely regulated as financial institutions. Generally, buyers might be seeking owner financing if they're unable to qualify through a traditional lender. This is one of the unique advantages of owner financing. Sellers may be willing to finance buyers who have low credit rating or are self-employed. However, buyers should be aware that sellers typically charge higher interest rates. This is in order to compensate for the fact that the seller is taking on a higher amount of risk. Part of the risk for sellers is also the fact that they might not see the profits from their sale for many years. Buyers who participate in owner financing should make sure that their contract spells out all the terms and conditions of the agreement. When a borrower falls behind on mortgage payments owed to a financial institution, the lender must go through the foreclosure process to seize the property. The same may not be true for owner financing. It may be that the seller can begin foreclosure immediately upon the buyer's default. Buyers should be made aware of all the different options available to them when they're seeking financing for a home purchase. This is why it's important for you to be aware of the different ways buyers can obtain financing.